hate to break it to you, but there's no magic crystal ball out there that can divine the perfect moment to buy and sell investments. If there were, there would be a lot of rich psychics. But that's not to say we're all left in the dark when it comes to managing our portfolios. A well-crafted exit strategy within our investment plan can give us clues about when it's time to move on from an investment and when to keep holding. Now, if you aren't familiar with how to create an investment plan in the first place, you might want to check out our other lessons on portfolio building basics. But in a nutshell, an investment plan is based on your unique investing goals, risk tolerance, and financial situation. It's your framework for deciding what to invest in, when to invest, and how long to stay invested. Your exit plan takes care of that last point, and it's a good idea to work it out before you need to consult it. So how do you go about designing one? Well, the following 3 questions can be helpful when defining your exit strategy. Have my investment goals, risk tolerance, or financial situation changed? Why did I make this investment in the first place? And is there a better investment opportunity out there? Let's examine each one a little further. First, have my investment goals, risk tolerance, or financial situation changed? There are many reasons an investor's personal situation might change. It could be that they achieve their long-awaited goal of buying a new house, or perhaps they're feeling a little more frugal and cautious after welcoming a new child into their family. Or maybe they inherited a whole whackload of money and everything is champagne and caviar. No matter what the change might be, investors should reevaluate their investment plan and adjust as necessary. In many cases, that means making broad adjustments to their portfolio's asset allocation or diversification, rather than tinkering with an individual investment or two. For example, if an investor needs additional income after a new child is born, they might choose to reallocate some of their equity investments into fixed income products instead. Now that means they'll need to sell at least one specific equity position. But which should they choose? To help maximize the returns of the portfolio, an investor would sell the position or positions they think might perform the least. Or they could also choose to sell at least part of the position that's become overweight in the portfolio to return it to balance. The next question an investor may ask themselves when creating an exit strategy is, why did I make this investment in the first place? Maybe they chose a stock because the company paid out a dividend and now the company no longer pays one out. Or maybe they chose to diversify their portfolio, but now they hold too many stocks from that same industry. Or maybe an analyst they trust recommended the stock as a buy and now it's been downgraded to a sell. Whatever the reason, it might be time to consider selling an investment if it no longer satisfies that initial purpose. The last question on our list that an investor might consider when creating an exit plan is there a better investment opportunity out there? Ideally, an investor can use idle cash to fund new purchases. But as we all know, money doesn't grow on trees. An investor might be fully invested and will need to sell an existing position to free up cash to buy something else. The important thing to remember is that the new investment should align with the investor's plan and not throw their portfolio off track. You'll notice that so far, I haven't once mentioned that the price of an investment should be used to determine whether to sell it or not. And no, I didn't forget. That's intentional. The cost of an investment is not normally something used to determine if it aligns with an investor's plan. That's because short-term market drops can usually be recovered given enough time. Look at the broad stock market crashes in the last century. Historically, it took less than 10 years to recover those losses. Sure, there might have been peaks and valleys along the way, but over the course of time, the trend has generally been up. It's one of the reasons that some investors buy stocks that are trading at all-time highs and rarely sell a stock just because the trading price is down. And here's some additional food for thought. The most someone can lose from buying $100 of stock is only $100, assuming they didn't use margin. But if they sell that stock too soon, they might miss out on it being worth a lot more down the road. Of course, investing always includes some amount of risk, and past performance doesn't guarantee future performance. So remember the key takeaways. Set up an investment plan that includes an exit strategy. An exit strategy should consider questions like, have my investment goals, risk tolerance, or financial situation changed? Why did I make this investment in the first place? And is there a better investment opportunity out there? Once you're equipped with an investment plan and an exit strategy, you're ready to handle whatever the market might throw at you. And that's a pretty good segue to our next lesson: how to weather a market correction.